Good morning, good afternoon, good evening, traders. Wherever you are in the world, I hope you're doing well. I hope you're safe. I hope you're healthy. I hope you've got a big smile on your face. And I hope you're catching pips as usual. Pips of Persia here. In today's video, we will be continuing our conversation about top-down analysis while we have a look at a trading scenario that has not played out, simply because it is super important for everyone to realize that mastery of these concepts will not just help you with better entries and risk to rewards, but it will also help you with avoiding unnecessary losses and protecting yourselves against such moves. So we'll be continuing our discussion on Euro Canadian dollar, and this will be the main scenario that we'll break down together. But if you haven't already, I encourage you to go and watch the previous videos on Euro CAD breakdown to have a more complete understanding of all of the higher time frame factors that led to this analysis for a much better educational experience. I'll leave the link for these videos in the description down below. So let's go ahead and jump straight into it. As a very quick reminder, what we were looking at for EuroCAD, and this was a scenario that started from a few weeks ago, it started from the weekly time frame. The idea behind this was we traded into this weekly institutional candle and we were expecting to see some lower time frame continuation of the bullish bias for us to be able to look into certain buy scenarios around here. So this as a higher time frame biased alongside of the daily or the 4-hour and the 8-hour break of structure to the upside that started to occur more or less confirmed these buy scenarios. So in a way, once we traded into the weekly institutional candle and then started to challenge the structure points to the upside, upon seeing all of that, we decided to identify a higher time frame point of interest and then monitor lower time frame potential accumulation at that point of interest. And the higher time frame point of interest that was identified was this 8-hour institutional candle right over here. And once we started to trade into this 8-hour institutional candle on the lower time frames, we indeed got signs of accumulation as we were approaching that point of interest. And then based on the break of structure of this accumulation and a lower time frame reaccumulation, we managed to trade this all the way to the upside. Now that's a very quick summary. If you want a more detailed breakdown, do go and watch the previous two videos. But the more recent analysis in a way is a continuation of everything that we saw previously. Once this trend started to form properly, it was clear that we have formed a bullish trend from this low to high to the higher low and the higher high. When you look at this structure on the 4-hour time frame or 8-hour time frame, this was in a way the trend that we wanted to take our trades based on. And I'll put this a little bit in replay mode before we approached our points of interest. But before anything, once the previous trading scenario based on this accumulation played out, the next potential entries would have been based on this bullish trend that has now gotten formed. Not only that, this accumulation in itself can prove as a zone of demand for us to potentially be able to take trades to the upside based on this level. It was quite interesting to see that parallel to this accumulation forming on the daily time frame, in a way it formed this institutional candle pushing down and then all the way back up. So not only we had the bullish trend, we also had this institutional candle on the daily time frame, which in a way gave more clarity and direction to the analysis, but in no way this is a full confirmation of our bullish bias. And based on everything we spoke about previously in the previous top-down analysis video as well, we had the higher time frame bias. Now we had that daily point of interest. We could even zoom into the 4-hour time frame and have a look at that point of interest again. And within the same region of that daily institutional candle, you are also able to see elements of institutional candles followed by imbalances on the 4-hour time frame. And these could be some attractive areas for us to keep an eye on. At the end of the day, we have got the bullish trend. We have got that previous accumulation. We've got the manipulation of the lows. And now we have just kept an eye on a potential point of interest for us to be able to take trades based on that. And this is where I'm going to switch the data feed from forex.com to FXCM, and this is where we're going to go ahead and have a look at the first screenshot that was taken on January 12th. Currently it's January 31st at 1 p.m. UK time, so this was roughly about 2 weeks ago. And generally speaking, this was the bias behind it, how we've created the bullish trend. We've got that 4-hour or the daily point of interest, and as you can see, I've written over here, that's our next point of interest. 4-hour institutional candle and the imbalance. Overall daily and the 4-hour structure is bullish from this low to that high to this higher low to that higher high. And this hourly bearish pullback should not throw us off. So what I've written over here, hourly bearish pullback, trust the higher time frame. I feel like this is also where a lot of traders get very confused. Let me go back to forex.com just so we can see this a little bit easier. When traders see a higher time frame bullish trend, however, they end up zooming to the hourly time frame and now they can spot this bearish trend. Traders get really confused, thinking to themselves, am I meant to buy this? Am I meant to sell it? Is it a bullish trend? Is it a bearish trend? Whereas in reality, you have to take this into account, that this bearish trend coming back down is potentially a pullback on the higher time frame for this bullish move. So in a lot of the trading scenarios, when we have the higher time frame bias and we start to get this lower time frame counter trend scenario, this is actually a good thing for us to see, because this is where we can go ahead and take trades based on lower time frame breaks of structure to the upside. Depending on where the last key structure point is, we can go ahead and take that into account. And if, for example, we start to challenge that to the upside, then indeed that confirms that bullish bias and we can start to take trades based on it. I'll post a few more videos about this a little bit later, give a few more examples of this lower time frame pullbacks within the higher time frame major trend and how to take trades based on it upon a break of structure. But generally speaking, you shouldn't let these lower time frame trends throw you off. So you know the drill now, you know how I like to operate. Now that I've got the higher time frame point of interest, I would monitor lower time frame as it approaches that point of interest for price action. And more than anything else, these would be lower time frame accumulation or distribution schematics being formed, where in a way it would confirm that given point of interest. So that's it. On the 12th of January, that was the picture, and that's what we were waiting for it to approach our point of interest, and then for us to be able to see the lower time frame price action agree with the higher time frame bias, and if it does, then we'd like to take a trade based on it. Before we move on to the second or the third screenshot, however, this is where I want to speak a little bit about the trade management element of things, and in this case, this is trade management before you have even taken the trade. In my opinion, trade management is managing your investment from the moment you think you're about to buy or sell it to the moment you've exited the entire trade. It's not just when you are actively within the position, it's also knowing what to do before and after. So I'm literally going to walk you step by step on exactly how I was managing this trade for myself, and I'm also going to speak quickly about a few mistakes that people would make when it comes to these type of scenarios. So let's say you've got your point of interest marked up, and in this case, our point of interest was this 4-hour institutional candle followed by this imbalance. So we're going to go ahead and mark that up once again. Now that I have that point of interest marked up over here, there is no need for me to keep going to the lower time frames and try to perfect this entry based on this candle. And the reason behind that is because these trades are not even confirmed yet. Although we have the higher time frame structure, this can very well start to break structure to the downside and continue to go lower, or this can very well reach below here and then continue to go higher. All of these are the scenarios that I have to take into consideration. So this is a number one mistake traders would make. They would identify the higher time frame point of interest, but without the market even reaching that zone, they would want to find that 1 minute institutional candle that they think it's going to react based on, and they would go ahead and trade based on that. How many times have you done that and you have seen a series of losses on your trading accounts? In my personal opinion, the correct way to manage this trade would be very simple. I've got my higher time frame point of interest, and I want to see if on the lower time frames, such as the hourly or the minute-based time frames, we are going to get signs of accumulation as we approach that zone, and if the accumulation is valid. Again, that second point is also very important. We have to get a validation of that accumulation, which again, we will speak about very shortly. But now that I know I have to see some type of an accumulation form here, and then get a break of structure to the upside before I take any trades, then what's the need for me to want to look at this level on the lower time frames? All I want to do is I want to go ahead and set an alert somewhere down here. Obviously, I'm not going to be able to do this right now. It's in replay mode, but I'll go ahead and set an alert somewhere down here, not necessarily exactly at my point of interest, a little bit higher in this case for me to have time to monitor the trade. And once it reaches my point of interest, then I want to see if it has accumulated. Then I want to see a break of structure based on that accumulation, and then I would want to go to the lower time frames and try and find that pinpoint entry. Because in reality, if I want to go to the lower time frames now, so let's put this a little bit more in replay mode and come to here. And I want to put this on 5-minute time frame and try and find which institutional candle or which imbalance I want to go based on. This is where a lot of traders would get confused on the lower time frames. Damn it, TradingView not letting me go that far back. Let's try that again. Okay, let's stick to the 5-minute time frame. But this is where the confusion starts from. This is where traders would be asking themselves, should I buy based on this imbalance, or should I wait for it to come down to this imbalance? Should I base my entries on this move? Or if you look at this on the lower time frames, if I'm not mistaken, there's a couple more institutional candles. That's where people get confused. They wouldn't know exactly where to take the trade based on. Whereas in reality, you shouldn't even be looking at that lower of a time frame, especially when your higher time frames are not confirmed yet, as it hasn't even approached our desired level yet. So very simple and very straightforward. This would be where I would set an alert, I would take a step back until my alert goes off, and then I would load up my charts again, have a look at it, reanalyze it, and see if it's ready for trade execution. But more importantly, I want to see if the trade is even valid. Let me switch this back into FXCM and we can have a look at the second screenshot now. So as it started to approach that higher time frame point of interest, this 4-hour point of interest that we discussed previously, indeed it started to give us signs of accumulation from the preliminary support to the selling climax, automatic rally, secondary test in phase B, and the final spring. And this was on January 13th, and as I've written over here, accumulation forming on the hourly as we approach the higher time frame point of interest, waiting for a break of structure to make accumulation valid. Probably a better word to word that would be waiting for a break of structure to see if it even is an accumulation. Although there's not much on this screenshot right now, I'm going to pause and I'm going to speak about this scenario again as well, because I feel like this is also where a lot of traders go wrong. Because once they see the market approach their level, approach this higher time frame point of interest, and give them signs of accumulation, they would in a way want to go ahead and blindly buy it there and then. This is fear of missing out kicking in. This is where traders cannot have the patience for the market to confirm their trades. And that lack of patience is the exact reason why they're constantly losing. And by the way, let me quickly remind everyone that scenario to scenario is different. Some scenarios I might not even want to wait this much for the lower time frame confirmations and take the trade based on higher time frames. Some scenarios I might pay a lot more attention to the lower time frames versus the higher time frames. It depends on a lot of different factors. The top-down analysis is a general guideline, not necessarily an exact set of rules to follow. And hopefully as we progress more in this channel and through the top-down analysis videos, you will get to know the different scenarios that can happen for you to in a way not want to follow a step-by-step do this, do that, do this, do that, and rather that learn how the market actually moves and be able to read the price action that's given to you. Little by little, we'll get to that. But if you are part of the group of traders that would just buy or sell based on an accumulation or distribution without it actually being a valid accumulation or distribution, then now you know what you can change in your analysis if you have been experiencing a series of losses. So again, going back to this screenshot, this is where the accumulation was seen. And in this case, the structure point that I kept my eye on would have been this high over here. And the reason behind that and the reason behind a line being there in the market is because that was my alert. And indeed, that can be looked at as the last major structure point on the hourly time frame. Clearly, we have this constant bearish move from the high to the low, lower high, lower low, lower high, lower low. You can even consider this your major lower high and this your lower low. So if you were more patient, you'd be waiting for breaks of structure up there and then trade it higher, or you could be waiting for minor breaks of structure based on this accumulation. And this would have given you more confidence in your trade and potentially more confidence that we are likely to break the higher time frame structure points to the upside as well. Now let's speak very quickly about trade management again, because now that first alert that we set off has indeed gone off. So we've received an alert that, hey, EuroCAD has approached your point of interest. We open our charts and this is the scenario that we see. Again, this is not where I want to go to the lower time frames just yet. This is not where I would want to perfect that entry just yet. This is still where I would want to see if that scenario is valid. And I know a lot of people were looking at this EuroCAD buy scenario, especially based on this daily candle over here. And you might still be confused why it didn't play out. So hopefully now you will have some more clarity as to why it didn't take place. Long story short, we've got the high time frame point of interest. We've got signs of accumulation as we are approaching that level. All I need to do now is set an alert for myself at this high. And then once that alert goes off, this is where I've received that minor or major break of structure to the upside. And then I'll be able to go to the lower time frames, 15 minute, 10 minute, 5 minute, and try and see what data I can go ahead and take a trade based on within this range. So again, it's a game of patience. You've set your alert, you know the direction you want to trade, you just want more confirmations based on that, and you have to stop over analyzing a chart for you to have a better chance of actually succeeding. And here's a hard pill to swallow for a lot of the greedy trades out there and a lot of the traders who go through fear of missing out a lot. If it doesn't break the structure to the upside, the trades are invalidated. Very simple. If it doesn't come up here, I am not going to buy it. It doesn't matter how far down it goes. It doesn't matter if it keeps dropping and maybe reacting off of this random institutional candle here or this random imbalance here. This is something that I see a lot of traders do. As the market keeps going in the opposite direction, they keep identifying more random institutional candles and imbalances with the hopes of the market reacting off of it. It's a lot more unlikely for it to start reacting off of these candles than it is for it to just break lower and break structure to the downside. So if it doesn't give you the confirmation, do not take the trade. And now this is where the third picture comes into play. And this is now on the 14th of January. We're just about 15 minutes into 14th of January. And as you can see, I've written over here, update, still no break of structure, so we wait. This is my alert line over there. I was still waiting for that alert to go off. I was still waiting for this structure to be broken to the upside. However, this started to break lower and lower and lower compared to our point of interest, which was that 4-hour imbalance or the 4-hour institutional candle. Some of you may be asking, how comes you're still waiting for a break of structure in this case? How comes you haven't decided that this is a no trade scenario because it has broken below your point of interest? Would you still be willing to take the trade? Now, here's what I want everyone to understand. Let me play this a little bit so it reaches the level that we were looking at over here. Have a look at the higher time frame structure. The higher time frame structure is still bullish, although this market came below our point of interest. Low, high, higher low, higher high. This is still a relative higher low. It still hasn't actually broken below our major structure points yet. So yes, we can still indeed consider bullish scenarios. However, they have to be confirmed. If we don't break structure above there, they're not confirmed. And you also have to take this into account, that the higher time frame point of interest was not a point of interest to take trades based on. That's very important. The higher time frame point of interest is not a point of interest to actually execute a trade based on. The higher time frame point of interest is an area to monitor on the lower time frames, and we normally want to take the trades based on the lower time frame confirmations. So this was where I was still waiting. I still wanted to see if we are likely to break structure to the upside, and if I saw that, I would have been more than happy to take the trade to the upside. However, that never happened. Let me take this off replay mode now. This market started to go lower and lower and lower from this accumulation that it formed. And now we know that that was most likely a redistribution scenario. And eventually it did cross below some of the more major structure points that we wanted to see. However, because we were patient and because we wanted to see lower time frame confirmations, this would not have been a losing trade. This would have been a no trade scenario. The trade is now invalidated since we have violated the structure that we wanted to take trades based on. Therefore, we would not be executing this. And if I want to come back to this and analyze it again and see if there are more trading opportunities, I would like to get rid of everything that's on the chart and in a way come back to it with a fresh perspective for me to not let the previous analysis judge my current bias. Let me get rid of a few things just to make this a little bit cleaner. But I'm going to reiterate again on the fact or on the idea, whatever you want to call it, that if we do not get the lower time frame confirmation of our bias, I am not going to execute the trade. This analysis didn't start using a Wyckoff schematic. However, I will be using the Wyckoff schematics to confirm my bias. And as we all know, a break of structure is what makes an accumulation or distribution valid. So until we break structure, I do not care about the accumulation that's forming over here. Also, I'm going to use this time to speak a little bit about the differences between accumulation and distribution from a completely different perspective to what we have spoken about so far, to help you always ask the right questions. Why do you even want to tell the difference between an accumulation or a redistribution? Would it have actually made a difference if in this case I would have seen an accumulation or redistribution to my analysis? In this specific case, it wouldn't have really made a difference. And I'll tell you why. Because everything that I previously was looking at was pointing towards a bullish bias. So I wouldn't even be considering this as a potential distribution over here. I would be monitoring it as an accumulation, but I would only take trades based on it if I am proven right. If I am not, and if this continues to be this redistribution and continues to go lower, then okay, I'm going to take a step back and not execute any trades. This is what I mean when I'm talking about over-analysis, when I'm talking about traders getting really confused because they are not stopping analyzing the chart at the correct time, because they're not patient enough to wait for a trading scenario, because they always want to buy it and sell it, they always want to ride every little move in the market, and before you know it, you are going to lose a lot of money with that type of mentality. So when you heard me say higher time frame points of interest and lower time frame continuation or confirmation of that bias, interest. Now you know what I mean. Now you know how I can have a higher time frame point of interest and monitor lower time frames as it approaches that level to see if it's actually valid. Now you see what a big part patience actually plays to my own personal trading. I don't take a lot of trades at all, maybe a handful on a monthly basis, but the ones that are being actually executed will reach high risk to rewards, and that's more than enough. Instead of me wanting to trade every single day, catching 1 to 5s and 1 to 10s, I would wait a little bit, have more patience. I stay in my trade slightly longer as a swing trader as well, but still chances are at the end of the month, I'll be looking at the same type of returns if I was taking intraday trades as well. You've seen on this channel how many times we've looked at trading scenarios that are 1 to 50, 1 to 100 and higher. And these happen a few times a month. Now imagine only one of these 1 to 50 scenarios a month. That's more than enough. Risking even 0.5% for 25% ROI per month is more than enough. So don't let your greed let you overanalyze and overtrade in these scenarios just because you feel like these are more advanced concepts and they're likely to play out. If anything, you have to pay even closer to attention to what the price is doing and what the price is telling you for a better chance of success. And by the way, you don't have to do what I am doing in terms of swing trading and paying so much attention to the higher time frames and having so much patience to wait for the trade to actually confirm before you execute it. We've spoken about the fractal nature of the market, so if you want to become an intraday trader, that's absolutely fine. You don't have to be a swing trader. You indeed need more patience, need more control over your emotions to become a swing trader, but these stuff would apply on the lower time frames as well. Even if you want to start your analysis on the hourly and finish it on the 1 minute, you still have to pay attention to the relative higher time frame and still in a way wait for that relative lower time frame confirmation before you execute a trade. So to very quickly summarize, what we looked at now was higher time frame trends. In this case was the 4-hour or the daily bullish trend, and based on that higher time frame trend, we want to find a higher time frame point of interest that's in agreement with our trend. In this case, we identified that 4-hour institutional candle in line with the daily institutional candle. So that's a higher time frame point of interest, which is now going hand in hand with that higher time frame trend. From there, we want to see that lower time frame confirmation of the point of interest in the form of accumulation and distribution. If we are approaching it, we would want to get break of structure. A break of structure to make accumulation valid, and then if we get that break of structure, then we would go to the lower time frame and analyze that for the actual trade execution. Why do we wait for that lower time frame analysis for trade execution? Because chances are those are going to be the more confirmed trades and the trades that end up giving us much better risk to rewards. And the reason behind it is very simple. If on the 15 minutes we are approaching some type of a point of interest and the market is accumulating at the same time, chances are, if you want to be risky and if you want to go ahead and snipe it at the spring, your stop loss is going to be based on a 15-minute institutional candle or some type of a 15-minute structure point. However, if you have that patience, if you just wait a little bit for the accumulation to get confirmed and for you to start to get signs of a break of structure to the upside, and either take the trade based on the reaccumulation that forms over here on the 5-minute, 3-minute, 1-minute time frame, or based on the pullbacks that you get, and then you're identifying your candles based on the 5-minute, 3-minute, 1-minute time frames, then obviously your stop losses are going to be based on the 5-minute, 3-minute, 1-minute time frames, or the structure points on those time frames. So it goes without saying your stop losses naturally are going to be much smaller. So the patience will indeed pay you. But with that being said, that brings us to a conclusion of today's video. I just wanted to very quickly go through this no trade scenario for Euro Canadian dollar. We've spoken about a lot of trades that have played out. I wanted to do an educational video on why this didn't play out and how you could have protected yourself against executing the trade a little bit too early. So I hope you got value from this video. If you did, do make sure to press the like button down below and subscribe to the channel if you're new. Welcome to the family and welcome to our community. I will continue with more top-down analysis videos and with more market structure videos. So make sure to press the notification bell down below and turn on the notifications if you want to be amongst the first people who get access to the videos that are going to be released. But with that being said, let's elevate and let's catch some pips.